The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, everybody. This is Ken Cavula from the Mid-Michigan chapter, and I'm joined this evening by my friend Mark Robertson. We'll be doing our investing topics, formerly known as Turnout Tuesday, and we'll be presenting that right at 8:30 Eastern Time. Right now is a great time to test your sound equipment or test your hand icon. If you look at your hand icon right now, it's not in the raised position. I know it looks kind of counterintuitive, but right now it's in the down position. If you want to raise your hand to ask a question sometime during the presentation, you can click that icon and it will change to a slightly different icon. But right now, the way the icon looks, that's in the down position. So we can avoid some inadvertent clicking. Mark and I have been discussing the program for this evening, so we're ready to go. Mark, I'm hearing you in the background. Do you have everything all set and ready?
I am. I'm studying this downward hand. It doesn't look like a downward hand to me.
No, it doesn't. It's a terrible icon, and that's why so many people get confused by what it's supposed to look like. If you don't want to speak to us out loud using a microphone, or if you don't have a microphone attached to your machine, I will be monitoring the question panel throughout the evening, and you can ask us a question in the text panel, and we'll try to get your question answered. This particular session is slated for about an hour. So we're going to aim to finish up somewhere around 9:30 Eastern Time. If you have any comments or questions, now is a great time to ask them. If you have something you'd like us to answer during this session, now might be a time to get that question in the queue. And we'll start immediately in about 3 minutes here.
Looks like Butch Lang has his hand up, or he's waving at you, Ken.
He might be. Let's see if I can. There we go. So, Butch, you're unmuted. Go ahead and speak, Butch. Okay, we must have an inadvertent hand. Butch, you are unmuted. Did you want to say something?
This is a trial on my part to understand that thing, so I was clicking it to lower it here, frankly.
Okay, and we're hearing you loud and clear, Butch. So if all that was a trial, that's a good time to make it happen.
What's the snow report, Butch?
I'm in sunny Mesa, Arizona right now, and it's great, but a little windy.
Oh, you cheater.
That's true.
Don't you feel bad for all your friends and family back in Minnesota?
I do indeed. Several times this winter. I'm headed back on 6th May, so
there you go.
There'll still be plenty to enjoy there, I'm sure.
I'm going to put the mute back on, Butch, and I'm going to lower that icon, and we hope you enjoy the presentation tonight. Anybody else have something they'd like to comment on or a question they'd like to ask before we get started? Now would be a great time to either raise your hand or type a question in the question box, and we'll try to get it answered for you either right now or before we start. We still have about a minute or two left before the actual presentation's going to begin.
Are we allowed to do any tax-related polling?
Sure, you can.
I've talked to
all that you want, Mark. You know,
I've talked to a whole bunch of people that were kind of blindsided this year by their taxes. And, you know, it's just there were some changes. I think a lot of us in certain areas of the tax brackets were not expecting. And what I'm specifically talking about is the amount of people who were switched from itemizing to filing the standard deduction, because that really proved to be kind of disruptive for us. Our taxes basically ended up about the same, but you know, I knew I was going to pay a small amount, and that's why I always wait till the last day to stand in line at the post office with everybody else. It's kind of a tradition. But they snuck
Well,
in.
I found mine a long time ago.
Well,
Dean is reminding us that Marty Eckerly had a birthday yesterday. So, Marty, if you're on with us tonight, happy birthday.
happy birthday to you.
Those things happen to the best of us. They just keep on a coming, whether we want them or not. So, happy birthday, Marty. We hope you had a great day yesterday.
You just have to embrace them and run with it now.
Thanks for the reminder, Dean. And Mark, I think we're close enough to 8:30 to get started. So why don't you take it away whenever you are ready, okay?
Well, Ken, it's later than you think. All right. Let's go ahead with our special edition. It's a session we used to call Turnout Tuesday. Now we just say it's stuff that we want to talk about with all of you, featuring Ken Cavula, my friend from a few miles to the north. And Ken, thanks for all that you do for our community of long-term investors. It's an incredible amount of stuff that you do. And again,
Thanks, Mark.
You're most welcome. My name is Mark Robertson. I am managing partner and founder of Manifest Investing, and we put this on as a program in collaboration with that community known as Better Investing, formerly known as the National Association of Investors, and we just have a good time doing that. Tonight's program, again, is kind of the tip of an iceberg a little bit. Ken and I are going to basically walk through some things that we are seeing, things that kind of rekindle some old memories of challenging moments with stock studies, specifically disruptions in the stock selection guide-based method of analysis. But again, we just want to go at this theme of the war on our stock studies, nodding our heads towards those things known as death and taxes, and the surety of that. And then I did discover along the way that there is a War of the Worlds 2. I did not know that until the other day. Here's our disclaimer. No investment recommendation is intended. This is all about education. It's about demonstration. We're going to talk specifically about a few stocks, including Apple. Apple being one of the most widely followed and widely held stocks by our community of investors. The stuff that we talk about is for demonstration, illustration, and education. And it's intended to share and explore and attempt to understand better the philosophy and methods of the modern investment club movement. And that's really what it is all about. Please do your own homework. If you have a friend or a family member who you think could benefit from these sessions, including our monthly roundtable sessions, we have another roundtable coming up in 2 weeks, April 30th. Send an email to ncavula1@comcast.net, and Natalie will take care of making sure you're aware of these sessions as they happen. I'm sure she picked up a few people today with her friendly reminders. Here's our agenda. Again, it's kind of a standing agenda for these type of sessions. Again, welcome. If you're fairly new to this, we do try to keep it fairly informal. We're just here to talk about a topic of potential interest to all of us. I want to spend a few moments with Captain Blunt. That was the nickname given to Ralph Seeger, formerly of the National Association of Investors. He was on the board of trustees, but more importantly, he was an investor practicing the methods of the modern investment club movement since the 1950s. Ralph was an engineer. He was involved in developing tools and resources for the community, worked very closely with the Better Investing investors all over the country. And we do want to spend a couple minutes just rekindling some of that, because some of the thoughts that he shared with me are the inspiration for tonight's session. We are going to talk about buybacks and the disruption that we see in our stock studies that is presented by buybacks. Taxes, mentioned them just a few minutes ago, a different flavor of taxes. We're going to talk about, again, how the tax law changes and modifications of this past year are beginning to manifest themselves in the middle of our studies, and they're disruptive. And then just a reminder about this general long-term trend towards increasing profitability, and make sure that you do account for it in your stock studies. We'll try to leave some time for open Q&A. Any additional thoughts, Ken?
No, but it's nice to see a picture of Ralph. I haven't thought about Ralph in a couple of years. He passed away about, I would guess 4 or 5 years ago, and the world is a less interesting place without Ralph Seeger.
Well, if you like that picture, here's another one. And Ralph, again, he was featured on the cover of Better Investing magazine back in June 2003. And the way I would share, Ralph was a dear friend. So I'm allowed to say this. He was probably the most incredible curmudgeon I've ever met in my life. And I think Ralph was a curmudgeon when he was born. I think in the delivery room he was a curmudgeon. That's how skilled and practiced he was at it. He was just a delightful, grumpy old man, probably from his youth. But he was also honest, helpful, supportive, loyal, all that kind of stuff. And he really was interested in helping everybody to become better and more successful at investing. So a few years ago, back when this cover story was part of the Better Investing magazine, I actually wrote a companion piece that went along with it that included some sayings from Seer, S-E-E-R, Seger, and there's some of them on the page here. And I thought we might spend a moment with a few of these. Ken, do you have a favorite on this page?
Well, I do like the fourth one down, and I like it more for the busting of a huge myth that it helps me put together than for its own sake. But I've always grappled with this idea of PEG ratio and PEs telling me something specific, and one size fits all as far as the rules are concerned. And Ralph was always very sophisticated when it came to PEs, talking about the fact that the individual stocks, and for that matter, individual types of industries, developed their own characteristics as far as PE was concerned, and there wasn't a one-size-fits-all pattern for investing, and we couldn't make hard and fast rules that we could never break. These rules about capping things at 30 or capping things at 28 or never considering a stock with a PE of 42 or looking at PEG ratios only under 1, all of those types of hard and fast rules, I don't think that they were ever intended to be something that all of us used all of the time. And I think Ralph was particularly adept at pointing out that there were a lot of flavors when it came to PE ratios, and a lot of different conflicting thoughts that had to go into the whole idea of comparing stock to stock just using a PE ratio. So I really am kind of fond of anything that he had to say about PE.
Well, I'd agree. In fact, we were confronted by not one but two audience members this weekend that questioned our sanity and wondered about when we talked about companies like Neogen several years ago, but even Amazon today or whatever, and this family of companies that Nicholson referred to as non-core, and he basically said, you guys are not doing NAIC investing. I think maybe we should tackle that again in one of these sessions in the coming month, especially focusing on early stage investing. But I like that last quote. Obviously, it's got to do with quality, and I love the notion of a low quality stock being directly related to unexpectedly blown head gaskets. But I'll draw us right back up to the top. I love tennis, and with the Masters this weekend, we had a special moment in the golf world as Tiger Woods returned to the green jacket for the first time in 15 years. He's now done that 5 times. There's only one person that's done that more. But just this notion, listening to Tiger Woods talk about his round, I mean, he's out there playing with some dynamic, powerful, and really exceptional 20-somethings, and he basically avoided losing just by plodding. He said he was out there plodding along, just trying to be consistent and disciplined. And boy, does that not capture the spirit of long-term investing, and this notion of having objectives and destinations. And you've heard us talk about dipsticks in the past, so I really do like that first quote quite a bit. Here's another full set. I know you've got a favorite on this page.
Is it about the torpedo, Mark?
No, no, no. That one's everybody's favorite. You've got to have another one.
Uh,
Oh, come on. Rule of 5.
oh, you're asking me for one. Okay. All right. I'm just kind of sitting here. I've been a little bit under the weather, folks, so I'm not as sharp today as I am some days. But yeah, I really like the first one. In fact, Mark and I have talked at length about this first one right here. In fact, we've done full classes essentially saying the same thing as this one says here, and that's basically this idea that sometimes you don't know why a stock is behaving badly. You just know it is. And there has to be a time when you get rid of that stock that's behaving badly, even if you can't quite pin down the reason that it's not performing the way your SSG says it should perform. We've been doing an experiment, if some of you remember, with the idea of relative return. And we've been saying that when a stock hits a 20% negative relative return, that means it loses to the market by 20 points. When the stock hits that particular benchmark, if you will, then it's time for us to jettison it from our portfolio. We've been having some issues with the details and how to make that jettison work, and we found ourselves being a little bit more in love occasionally with stocks than we thought we were, because when it comes time to pull the trigger, sometimes we've had a little bit of ambivalence as to whether or not the experiment should proceed. We've told ourselves we're going to do it, but we get to that point, and even with imaginary money, pulling that trigger is difficult sometimes. But Ralph wasn't talking about something that we all don't experience, and that's that sometimes a stock needs to be sold, and it needs to be sold because well, you know, a lot of times you don't know exactly the reason that it's not performing, but it's not performing, and that's a good reason to sell sometimes.
Yeah, I love that one too, because he's still quoting stock prices in pieces of 8, so that dates it a little bit. And the other thing, I can actually picture him saying this and then following it up with a twinkle in his eye and a wink. That something that is wrong is probably you, comma Mark. So yeah, this is, that one definitely brings back moments. But yeah, I like them all. And then I think I would just close with that last one. I think that Ralph certainly recognized that, you know, Don Danko led off the article with do, get out there and do it. Kind of Ralph Seeger's own version of just do it was do and do and do. You learn by doing. And with curiosity, energy, and I would say deployed imagination on the part of an investor, you can uncover and interpret, most importantly, facts. And facts matter. And he just had so many nuggets. I thought it was worth sharing a few of these. Those are so fun, and the torpedo is absolutely true too.
Well, Mark, that third one from the bottom also. I mean, we just ran a workshop in the Mid-Michigan chapter. We had 100 and some odd people sitting in a room for a full day, and we kept pounding away at this idea that you had to have sales growth in your portfolio, that your weighted average sales growth, your aggregate sales growth had to be up around 9, 10, 11, 11.5% if you were going to beat the market, if you were going to perform. And I think that in a very succinct way, Ralph is basically saying, follow the rules that we've set down for you in better investing, because if you want that high rate of return, then you need to follow some rules, and some of those rules are going to tell you to take a little bit of risk. That's all there is to it. You want to look for some of your higher flyers. You can mitigate your risk by looking for high quality, and I think he speaks about quality in some of these other rules right here. But the whole idea of wanting a higher return is tied intrinsically to this idea of you need sales growth, and you need it at a high enough rate so that the earnings will follow that sales growth and the stock price will then follow those earnings. That's the only way that over the long term you can make decent money on a regular basis in the stock market, as far as I'm concerned.
Yeah, and I love that you avoided price volatility as any measure of risk, because that's certainly not what Ralph was talking about.
Absolutely not, no.
Talking about a little bit of friskiness. But tonight's presentation is about this quote, which wasn't in that article, but it's something he said to me when we were talking. We had a several fairly deep conversations about the analysis method itself. And what he talked about is some concerns that he had. This would have been probably almost 20 years ago, about variations in shares outstanding with either buybacks or the dilution of lots of stock being issued in particular companies. Shares outstanding variations can bring our analysis methods to its knees. And we'll take a closer look at what he means by that, but it basically comes down to the fact that we graph a top line, which is sales or revenues, and then we compare it to a line that is per sales, the earnings per sales line. So when you're basically playing with one of those two and not playing with them together, it really can cause some disruptions. It's actually at the heart of companies that have EPS growth faster than sales growth in many cases. And that's kind of what he was talking about. And then I follow that up with Buffett's comment about share repurchases being grossly and vastly misunderstood by the general public. In fact, to the point where it's actually on the floor of the Senate or in committee at the Senate to try to do something about taxing and stopping the practice of buybacks. And that's kind of crazy to me. Any thoughts on that, Ken?
Well, the vilification of Wall Street is proceeding step by step in our politics right now, and I think we're going to have some real serious debate in the next couple of years about different types of practices that a part of the population feels are unfair and that don't work in the best interests of the general population. I'm not sure that that capitalism has a real understanding of the fact that there are rules that take you too far. There are things you can do that go too far. And when you have populism rearing its head in the political arena, I think that capitalism is up against a formidable foe, and I think it needs to very solidly state its case for why what it's doing is correct, and at the same time maybe wring some of the excesses out of the system the way it's operating at the moment.
Yeah, I would concur. I think George Nicholson spent a lot of his time talking about just the overall concept of capitalism as a good thing / own your share of America, with a lot of virtues. And I think a lot of the virtues are offset by some of the misdeeds and / greed that we do see these days. But yeah, you're right. I'm kind of tickled that that last statement there by Buffett, assessing the desirability of repurchases, isn't that complicated, because that's where we're going to close tonight, time permitting. I actually ran some quick calculations I don't think I've ever seen anybody do before, which could be fairly interesting. And then I also want to point out that a lot of stuff that we talk about here tonight breeds confusion, which is not helpful to capitalism, in my opinion. But all of the stuff that's going on with the repurchases, the tax rates, the shifts in profitability, productivity changes, all that stuff that makes the analysis more difficult, in combination with the stuff that Wall Street does to take complexity and breeds further complexity from it, there is opportunity. Because once you nail your facts down and you practice some of that discipline, patience, and get some deeper understanding, the stuff that Seeger was talking about, there is opportunity there too. All right. So with that, let's talk about buybacks. They're at a record high. And you can see some track record there. That's a Barron's graphic on the upper left. And in fact, the bar for 2019 is projected to be significantly greater than the bar shown for 2018 there. And a longer term track record that you can see buybacks superimposed on the green background of the S&P 500 index. And you can see that you can certainly make a case that there's some foaminess and some frothiness and some frenzy here. That it seems like every time stock prices tend to shoot up and tend to gain a lot of momentum, it carries a lot of the people in the corporate boardroom who vote on buybacks along with it. And you can actually go back even further and find further evidence of anytime there's an enormous amount of exuberance in the market itself, it does seem to drag some of these guys and gals that run these companies right along for the ride, basically making ill-timed / ill-fated investments. Your thoughts on that, Ken?
I tend to agree. I'm not certain that I understand fully the reason for share buybacks, and to me, many times I think it's a signal that the company has run out of good ideas, run out of good ways to spend its money. I'd love for us to move back just a couple steps away from buybacks, back to the place where a good solid dividend payment right back to the people that made the investment in the company in the first place was another way to return capital to the investing public. I know a lot of the public relations about buybacks indicate that it's a way to return capital because you're theoretically raising earnings per share, but in the whole accounting frenzy that follows a buyback many times, I'm never quite certain whether that flows all the way to the bottom line the way that the theory says it's supposed to.
Yeah, I would agree with that. And then the person who made whoever the person was that made this CNBC appearance is basically making the case, or attempting to make the case, that buybacks are artificially inflating the overall market and have for the last couple of years. And I'm not sure I buy that completely, but there's some stuff there. So again, let's talk a little bit in the context of Apple. Apple is a company which they've actually made the choice of buying back some shares. In addition to what Ken just said, they initiated a dividend a few years ago and have been fairly handsomely increasing that. So they are trying to return capital to shareholders using both techniques. And by the way, I'll put a really nice summary of, which includes those previous graphs, in the session notes on our forum. But again, this comes back to Ralph Seeger's comment about, again, that top line is sales, the green line being sales or revenues, and that bottom blue line is our earnings line. But keep in mind that's earnings per share. So all other things equal, nothing else changing. If you decrease the number of shares, you can actually encourage that blue line to approach the green line in our analysis technique. And that literally is what used to drive him a little bit, I'll just say, anxious. Okay, so I thought we'd take a little bit closer look at Apple. As you dive into the online tools, you'll see evidence of this changing landscape in terms of the number of shares outstanding for Apple. This is the Apple annual data. And you can see that they've been taking several million shares off the market over the last 5 years. You can see that it hovered pretty much in the 6.5, I believe that's billion shares. I guess that's thousands of billions. I don't know, whatever it is.
It is billions, Mark. Yeah, that's billions. 6.5 billion.
6.5. So it hovered pretty close to that for 5 years, and then as they started this campaign of returning capital to shareholders, including a dividend, which shows up on there also, they've begun whittling away at their shares outstanding. Okay, so that's where you pick up on it. Here's another place to spot it, and you want to be aware of this. In this case, the single value line analyst is taking a look at the shares outstanding for Apple and is projecting no particular slowdown and not much of a plateauing in the reduction in the number of common shares outstanding. You can see going from current levels right around 5 billion shares outstanding all the way down in the next 3 to 5 years to $4 billion. That's a pretty ambitious. That's a lot of money, obviously, at $200 a share. Apple has a lot of money, but we're talking about a fairly significant reduction in the number of shares outstanding for Apple. All right, what's that do to us? Well, here's a picture of what that looks like. Like I said, the graph at the bottom of the page, it was kind of leveled off in that mid to low 6 billion shares outstanding level, and they have just steadily been whittling away. And then you can see the projection taking it all the way down to the 4 billion mark. And the company has actually slowed down. If you look to the right-hand side of the visual analysis, the sales do seem to have slowed. The people who follow Apple think that it's time for the next big thing, the next cell phone or whatever the world they're working on now. But the overall growth is somewhere in the upper mid single digits. Profitability has actually been pretty good, but you can see that in order to get to these type of return numbers, you have to be willing to assume that they will follow through on that reduction in the total number of shares outstanding. And it's a pretty challenging specter facing all of us. How much does it matter? Here's a side-by-side look that if you went through and did the analysis using the 4 billion shares outstanding according to the 3 to 5 year value line forecast, in other words, this number that you see right here, we're talking about a projected annual return, again, number comparable to Section 5 of stock selection guides in that 12% range, which is certainly a strong hold, if not buy, under most conditions. If, however, you take a look and you basically make the assumption, as many of us do, we talk about as we do our stock studies, I'm going to be conservative. I'm going to assume that they're not going to follow through on that intention to buy all those shares outstanding, going to plateau or stop somewhere in the $5 billion range. Again, you're talking about, with all other things equal, a return of about 7%. And that, again, is in the hold, but it's certainly in the center, the type hold characteristic. So, that's one assumption. Think of this as a sensitivity analysis on that one variable or one parameter. The willingness to make that assumption that they're going to continue on this trend generates a 12% return versus a 7% return. Any question or comment on that, Ken?
Well, I think the next slide is the preferred procedure as it shows in the tool, isn't it? No, we have to go one or two more slides yet. There we go. I am so distraught a lot of times when I try to sit with clubs and talk about the preferred procedure, because first of all, I find that there are a lot of folks that don't prefer it at all, and they tend to completely ignore it. I think that this exercise, more than almost anything else that I do on a regular basis, helps me understand what's happening with the company. And when I go through that preferred procedure, and you kind of moved it right off the slide, the slide there, Mark.
That's because I'm going back to the tradition.
Oh, okay, all right. Well, when you go through the numbers, when there's not a lot of disruption in the force based on taxes, and when there's not a lot of disruption in the force based on share buybacks, then historical values, which is what the defaults are based on. The default numbers in the preferred procedure are good, solid historical values. The problem is that those historical values were significantly disrupted by the tax law in the last fiscal year, and then the share buybacks are disrupting the shares outstanding for us to go forward with. We now, for most of our companies, especially those that follow the calendar, we now have one new annual tax figure to base some of our preferred procedure judgments on. But all the other tax figures are much, much higher, and they're higher because the tax rates were higher. Well, the same thing's true about shares outstanding. All of the numbers that you can pull up for your research are historical numbers. And what you're looking for is that call, such as Value Line makes, for the future. And if you're not willing to at least consider that call, consider the fact that the board of directors is calling for a continued decline in numbers of shares. If you're not willing to consider that, then I think that you're not taking the necessary risk that Seeger talked about in some of his tips and tricks for what we're talking about. If you're not willing to take that little bit of risk, then you're going to end up with results that probably keep you out of a lot of stocks that maybe you should be moving into. Maybe it's the difference between a strong hold, an upside downside of 2.5, 2.6, 2.7, and a buy at 3.2, 3.3, 3.4, something along those lines. The preferred procedure is a wonderful, wonderful tool. But right now, and for the next couple of years, you can't just depend on the defaults and read the result. You have to reason your way through every single line on the preferred procedure. And since most of our companies don't do preferred dividends, that's the fourth line down, we only are talking about reasoning through 4 lines. And the first line is basically what you did when you determined what the sales growth was going to be. So you're going to want to add to that some net profit margins, some pre-tax profit margins, some tax numbers, and especially some shares outstanding numbers. Take a moment, take 5 minutes, and think your way through the process so that you end up with an earnings per share number that has some semblance of matching something that the analyst might be telling you. And if the analyst numbers are much more aggressive than your preferred procedure numbers, I tend to want to stick with the numbers that I'm understanding and following through on. Analysts tend to become extremely aggressive a lot of times, and then 6 months from now, or 9 months from now, or 12 months from now, as the picture doesn't play out exactly the way they thought their thesis was going to play out, they massage those numbers lower and lower to match reality. I'd rather start with a little bit more of reality and keep my SSG in what I consider to be a conservative place, but not such a conservative place that I miss opportunity on a regular basis. That's a long explanation, Mark, but take it back, okay?
No, it's a good one because in addition to what you just described, which is obscured opportunity, I've also seen an equal number of situations where you have a blue chip, very core holding that if you make these type of assumptions, it can be in the sell zone when it shouldn't be. So you could literally be walking away from a company that you really don't have to sell. One of the reasons I made this slide was I think this is for the manifest. Yes, it is. It's for the manifest 40, which is our 40 most widely held stocks, and basically just added up the shares outstanding just to make the point that it's not just Apple. The average company has a decline in shares outstanding of about 2% per year. And if you're not factoring that in, because this is 40 very widely followed companies, you want to basically, and everyone is different. There are a few that don't match this profile, but the general rule is for them to be this type of a picture. And you want to make sure you understand that and allow for it. And again, just to reinforce what Ken was saying, this is actually from an article by Cy Lynch back in 2008, where he was talking about traditions, and I'm not sure what he's talking about when he talks about the Atlanta Braves and eat more chicken and who knows what. And in this case, he's talking about a muskrat beauty contest. But the essence of his message really was that George Nicholson and Ralph Seeger and all those people referred to the preferred procedure as the preferred procedure because it was preferred. And that sounds absurd. but that we don't follow that. At Manifest Investing, we use the preferred procedure for every single company analysis that we do. And the reasons are shared right there in the book by George Nicholson and Tom O'Hara. It beats just drawing the line. And I am a fan of crayons when it comes to stock studies. I'm a fan of Peter Lynch's 30-second, if you can't say what's great about a company in a minute or so with a bunch of your partners, and then follow it up with the crayon analysis shown on a visual analysis, that's all good. The thumbnail is a good thing, but when you really dig into the company, as Ken was just saying, you want to have a deeper understanding of profitability and life cycle based PE selections, all that kind of stuff. The preferred procedure was preferred. And for all the reasons that Ken was just saying a minute ago with the preferred procedure, the same stuff is happening in tax rates. Again, the point that Ken was making, that when you're looking at a stock study using a stock selection guide, which is focused on the average of these 5 years, it's not necessarily leading you to the right point of an analysis, in my opinion. I mean, this is the situation that's currently expected, at least for a pretty good portion of that period. It's probable. You're going to see companies in that 20% range that used to be up in the 25 to 30% range. And until there's a major legislative change, that's the type of thing that we're going to be seeing. That's the type of thing that as you go through your preferred procedures on your tools, you want to make sure you understand, what type of things are you looking for here. So here's a look at, again, a relatively small difference in the tax rate. That's the only change made on these two slides. The tax rate and the shares outstanding reduced to that 4,000 number. Again, we're getting up to the point where this forecast is materially different than that one on the left. So again, as you step through these, make sure that you form some opinions, some well-formed, considered opinions about where this stuff seems to be headed. Any comment to that, Ken?
No, I believe it 100%. I use the preferred procedure on a regular basis. I think my way through it, and that's not to say that there aren't times when I take and accept the default values. There's very little guidance on future taxes in many of the companies that I study. So as I get a tax rate for a full fiscal year past all of the disruptions that occurred in December of 2017, as I get a tax rate, I might have kept that 18.3 or dropped it to 18 or to 17.5. I'm sure that 16 is a relatively decent number, and if the company is helping me, then I'm finding this kind of guidance in some of the numbers that they're publishing, and I'm using that kind of guidance to help me figure out what the perhaps compounded annual growth rate will be into the future.
Okay, and let's go ahead and talk about the last piece of that puzzle, the profitability. And this is a curve that many of you are familiar with. Starting with the bottom curve, that's the entire value line arithmetic index, x the financials. And again, we're talking about the net margin of, in this case, about 1,300 companies over time. So you can see the impact of the 2008-2009 recession. That literally is what happens to our guides in a recession. You can see some recessionary tendencies right in here the last few years when things got a little bit tired and the global recession hit. But the point that we want to make is, again, as Ken was saying, if you're looking at the default values are basically looking at these numbers, okay? And how these numbers compare to these numbers is an important consideration for anybody doing a study. If you assume 7% when the company is literally projected to do 10, you are really short-circuiting the potential of that company. Doesn't mean you're wrong, but I would look at this situation for the average company and say I want to be making projections in that 8, 9, 10% range, based on the facts and the information and the trends that we see. The one up at the top, I had never done this before until today. It's always fun when I run into things that we do for you guys that I've not done before. This is the Manifest Investing 40. Again, the 40 most widely followed companies by our community. And mine is the financials. I think there's 3 financials in the Manifest 40. So the 37 companies, what I want you to notice is the scale change. Notice how much higher the numbers are. It's the same parameter, same characteristic. But the other thing to notice is look at those recessions and recessionary conditions on the bottom. Again, this is just one more feather in the cap of, what makes a quality company. And part of what makes a quality company is being a leader in the profitability arena amongst its peers and competitors. And those are the type of companies that we tend to follow and try to discover and own like good stewards during our lifetime of investing. It's kind of a cool chart. But again, for the type of companies that we are generally exposing ourselves to in our most widely followed stocks, they're higher and they're steadier. That's kind of a cool chart. Don't you like that one, Ken?
I do like that one, Mark. I do like that one a lot, yes.
I thought you would like that one. Yeah.
It's very clear. It's a very clear chart.
Yeah, I mean, why not invest in the best of all of the above investing? Good stuff. So again, just as a reminder, this just reinforcement on what Ken was having to say. I made this slide before we talked. Again, those default values are generally operating off of a 5-year trailing average, and that can be a good thing for a fairly steady, solid state company that's on a fairly constant and cruise control guide path, if that's the way you want to think of it. But a lot of companies are not. This is from an analysis that we had done in the past on Church and Dwight. And just pointing out that if you were using the trailing 5-year pre-tax profit margin to build your forecasts, you basically are not giving it credit for the trend on the upper left. And the graph on the right, the red bars are basically what happened. The purple bars are the forecasts that would have been generated by default-based stock selection guides over those years. So you can see that, again, there's a shortfall there that you want to avoid. You want to be always looking. I mean, the rearview mirror is important, but so is the windshield. Always be looking forward and accounting for that as you go through your preferred procedures. All right, are we ready to talk about this, Ken?
Well, we are, but I'm going to interject a few comments and questions from our audience, okay?
Okay.
Nick Strategos from Pittsburgh indicates that if you're looking for input into the preferred procedure, in his experience, one of the best places to get some of that information is to read the minutes of the analysts' meetings that occur after every quarter of earnings or after the fiscal earnings come out, that many times management is going to kind of telegraph some of these numbers that we're looking for. I have found, as Nick says, that these are a wealth of information, and many companies are talking about effective tax rates going forward, and they're trying to give you that very information that you need to use the preferred procedure. They understand, as well as we do, that the history that is there for tax rates is no longer a valid indicator of what tax rates are going to be going forward. So they're willing to give you their best guess of effective tax rates for the next year. Now, they're also making it quite clear that they're doing some guessing in the whole process, and they won't be spot on necessarily, but they're willing to adjust those numbers as the quarters go by. And then as we get 2 or 3 years of history, we begin to have something that we can use for our own decision-making process, whatever that happens to be. We're getting a number of comments from a number of people that want to know if the purpose of the income tax cut for corporations was for them to buy back shares of stock. And I don't think that's something that Mark and I can divine. I think that the tea leaves are out there for everybody to read and interpret in any way they wish. But the purpose of the tax cut is whatever you want to read into it. I'm not quite sure that anybody, even in the government, would give you the same answer as to why they thought that the tax cut was necessary. I'm hearing a lot of debate among ordinary people that the tax cut hasn't filtered down to the general population. I'm not sure that I believe all of it because I can look at my total taxes paid the year before last and my total taxes paid this year, and I can tell real quickly whether or not I actually paid more tax or less tax. And I have to, of course, compare that to what the adjusted gross income number is as well. But I'm not prepared to give you a reason for why the tax cut was passed and whether or not companies are following through on their end of the deal. Mark, do you want to step into that swamp or not?
Yeah, I will step into it. The biggest problem is it's not as big as everybody thought it would be. Mostly because people distort and some people lie when it comes to situations like this when it gets political. I don't know how many times I heard about the 39% tax rate going down to 20, and that basically being a 50% reduction in the amount of revenues that the federal government would take in, and all that kind of stuff. And look at the chart, people. This chart shows you that we were already most of the way there. The average company was already paying an effective tax rate of 25%, and it only went down to about 20%. So we're talking about a relatively small amount of money when it comes to tax flow, cash flow for the federal government. There's a lot of reasons behind that, the slowing economy, and what do they call them, inversions? As I said, there are inversions with the companies leaving the United States. And locating stuff offshore, all that kind of stuff. Anyhow, the difference is not as big as anybody would have possibly expected. I'm kind of in the camp where I don't think we should have income tax if we could just corporate income tax. If we could just get down to the point where they would divert those funds to compensation, which would be taxed on an individual basis, and then also facilitate working capital and new projects, all that kind of stuff, and including the dividends Ken was talking about to shareholders and buybacks, all of those things. Now, I did run into a fairly decent analysis. There's a couple that I'll put in the session notes that are beginning to take a look at where did that stuff go, and is it having the desired effect in any way, shape, or form? And I think it's definitely worth trying to weigh and come up with. But again, it's not as big a deal as most people talk about it on both sides, as both sides of the issue. Kind of thing we run into.
Mark, I will take a small step into the swamp to make the point that we try to be as nonpartisan as we possibly can, and we try to use facts and figures that are based on facts and figures that are being reported and collected. I still am old enough to believe that there are facts and then there are opinions. And I'm not sure that you can have the opinion on a tax rate. I think that if the company says this is what we paid in taxes and that works out to this tax rate, I think I can do that calculation. And then I should not have an opinion that the company lied. I think that kind of reasoning has moved into a lot of our political process where we become more and more divided as we decide and choose which sets of facts we're going to take as reality and which sets of facts we're going to choose not to believe because they're fake. That's as far as I want to wade into the swamp. But I will say that if Mark is putting up a figure on a graph, or if we're using figures from companies, we're trying to be as accurate as we possibly can be. And that means that almost every one of those figures can be double-checked and cross-checked and calculated to make sure that they're actually numerically, algebraically, arithmetically, they're correct. So I don't agree with those of you in the audience that are saying, I just don't believe the figures. I think that's throwing your hands up in the air and saying I'm on one side or the other, rather than trying to dispassionately look at the facts and try to draw some conclusions from the facts.
Oh yeah, and I just for clarity, I wasn't accusing the companies, for most of them anyhow, of lying. I think what it comes down to, and it's not even necessarily a lie. It's some form of cognitive disorder with many politicians. And that's who I was talking about the 39% versus 20, and they really don't. They either don't know or don't want to understand the realities. No, I think very, very few companies actually mislead when it comes to this kind of stuff.
Yeah, I'll say the same thing that Dennis has said in his comment. I was a little bit surprised when you said that 25% to 21% was not a significant reduction in taxes. I think it was a significant reduction for corporations. I just don't think it was as large as some people thought it was when it's all said and done. I still think 25% to 21% is a pretty decent cut in taxes, and I was expecting corporations to do a little bit more with that money. That's a very personal opinion.
Well,
We're also getting some comments from people. They'd like to know, do we consider Value Line to be partisan, or do we consider Value Line to be objective?
My personal opinion is that they're very fair and trustworthy. I have no problem with Value Line in that regard. Whatever.
Okay.
So, anything else from 35,000 feet?
I am ready to move on, Mark, if you're ready to move into that last slide.
Well, this last slide, it comes back full circle to this notion of buybacks. Are they good? Are they bad? There's a lot of stuff being kicked around on it right now. You can find inflated and potentially erroneous opinions in both directions, so I'll just leave it at that. But what it comes down to is there are a few people that believe that the market has been pumped up, that sort of thing. But I came back to something I don't think I've ever seen anybody try to do this afternoon, where I basically took a look at, and I was using Value Line as the reference. Anybody who wants to actually crunch through these numbers, I took a look at the differences in the numbers of shares outstanding for these companies, and I did the Manifest 40 just as a quick sample. I went back and looked at, well, what was the net change in shares for these companies in each of the last 10 years? And again, what we're basically tackling is this question that Buffett proposed that's probably not that difficult to chase an answer to this, but think of the person sitting in the Visa treasury, in their investment treasury department, and the person who's responsible for making decisions to go out and repurchase. When the Visa treasury person repurchases shares, they literally are buying shares from a Visa, could be buying them from Mark and Ken, and basically restoring them and taking them out of the shares outstanding. That's the way it works. So what you can do is go back and look at the differences in year over year for the last 10 years. And then I made a very basic, very global assumption. I said, what if they made those transactions at the average stock price? And I just used the average between the Value Line high and low for the 52-week period. And so what you basically end up with is a look at the cash flow stream of a series of decisions made by the person in the Treasury Department for each one of these companies that is buying and selling shares. And on this particular list, it's people that just had net repurchases or net buybacks, and literally took a look at, what did that cash flow look like over time, and what was the rate of return on it? In other words, what are those shares that they purchased over that 10-year period? What is the rate of return on it? So what you literally have a picture of, at least as a preliminary first glimpse, is the companies that seem to do a little bit better job of this. The companies up at the top of this chart have generated a better return. Again, we're focusing in on the decisions made by the Treasury person taking shares off the street, versus the companies at the bottom. Now, Ken observed quite obviously that a company that has really suffered, like a General Electric, for example, they're skewed to the bottom of this list almost naturally. And again, General Electric, the situation at General Electric is they bought $50 billion worth of shares. Most of that $50 billion spent within the last couple of years for shares that are now worth $17 billion. So 50 went to 17. That's not exactly stellar performance. And even at Apple, where the stock price has been going up year over year over year with a few pauses and speed bumps, they basically have bought back $362 billion worth of stock. The return on those decisions, those transactions, has actually been 17 or 18%. So I'm questioning, the validity of this. It's just out there. It says preliminary in red, but I do find it kind of fascinating because there have been a number of times when we have wondered about the wisdom of a company buying back shares under what seems to be the wrong conditions. And it's no more complicated than what you think. If your company, let's say it's Stryker, if Stryker is trading with a projected annual return of 2% and they're out there buying back large baskets of stock, that's probably not a very good decision, because like Ken said earlier, we do tend to think of the repurchase of company shares as kind of a last resort. They've got, they could invest in the company, they could pay their people, they could do a number of things. And when they run out of things, they get to that buyback. And then the question is a buyback a good thing? And the only way we have to judge that is the results of our stock studies, known as the return forecast. And we have seen case after case where it doesn't look like they're doing their stock studies very well. Any comment?
Mark, I'm gonna suggest that this chart be expanded by 2 columns, and the next 2 columns that I'd like to see on this chart would be a rate of return for the stock itself. A compounded annual growth rate for the last 10 years for that stock, and then I'd like just a simple calculation of how much better or how much worse did the company do in the buyback compared to the stock itself that was sitting out there.
Okay. Sounds interesting. I don't have an expectation for that, how that would end up.
Well, I'm feeling that might even out this chart a little bit, but I'm not positive. That's my gut just says that would tend to even the chart out. I'm looking at the companies that are on the chart here, and I'm saying to myself, I wonder if the fastest growers haven't moved to the top and the slowest growers haven't moved down near the bottom. I see CVS, GE, Qualcomm. I see them down near the bottom. Now, of course, Qualcomm really did a big one today with its huge jump up in price today because of its settlement with Apple. But I'd like to see those 2 columns to see what happens and whether or not the companies are really as good. I'm thinking to myself, if the Visa stock had a compounded annual growth rate itself of 50, and I know it doesn't, but if it did, if the company was only able to squeeze out 26.2, maybe that's a problem. You know what I'm saying?
Mm-hmm.
Okay, so I'd like to see those numbers if they're easy to come up with, and they sound like they might be easy.
Those would be relatively easy to come up with as far as the 10-year profile. And again, I think one of the things you'll see us do next is to take a situation. I hate to pick on General Electric, but they're vulnerable. General Electric made that massive stock repurchase after the stock price had recovered back into the 30 range, and most of the stock they bought was between $25 and $30 a share. That, by any stretch, was probably not the best decision, when just months before that they could have bought shares at $10 a share. That's just one example. The other ones that I think will prove interesting to look at is just companies we have questioned. How does we'll basically be looking at the cash flow for repurchases. So in other words, when did they make their biggest repurchases? How does that line up versus a Chronicles? and we'll overlay it on a chronicle and see what that looks like. I think it'll be fascinating in some cases.
Mark, we have a couple people. Bill Thompson is one of them. Would like you just to explain that current value column one more time, how you came up with that.
Okay, the current value would be the net of their repurchases over that. It's mostly 10 years. Some of them are 8, but mostly 10-year periods. So that's the total number of shares. It's net because they could have actually sold and issued shares also. So it's the net number of shares times the current stock price. So literally the net purchases of Visa, total number of shares times the current stock price will give you the current value of those treasury shares in order to do our judgment as to what type of decisions were they.
Okay, and this is definitely a work in progress that we're both kind of interested in this, and we'll try to bring back some conclusions the next time we meet in an investing topics. We're getting a couple people asking you to expand this to some other companies, and Mark will be expanding this column to include more companies than just this, right? But that brings us near the end of this session for today. We've had one very patient person the whole time, and I'm wondering if it's an inadvertent hand or if John Vander Creek is just waiting to speak. John, I'm going to unmute you, and if you have something to say, well, you must be muted at your end because I can't unmute you. In fact, yes, you are self-muted. Okay, so I'm going to assume that's an inadvertent hand and take it down. Folks, we'll be traveling quite a bit between now and next November. So when you get a chance, if you're anywhere near any of these venues, the one coming up right away is the first weekend in May in Pittsburgh. That should prove to be a lively session. Pittsburgh always is a fun place to talk. So if you're anywhere near Pittsburgh, check out their website on their homepage, on the Better Investing website. Get some information and join us in Pittsburgh. We'll all be, Mark, myself, Cy, and Hugh. All 4 of us will be at the National Convention this year in Chicago. If you're in beautiful Michigan, up near Traverse City on June 1st, we're going to be doing a program up in Traverse City. That's always a really great time. We bring our wives, we make a weekend of it, and it's a wonderful, wonderful resort place to just relax and have a nice time. Mark's going to the Carolinas. We're both going to Oklahoma City. I'm going to be with Cy and Kim in Atlanta, and Mark and I are going to Seattle in November. We'll be adding dates to this calendar as people call us and schedule things. But for now, we'd like to wish you all well. Thank you so much for spending the evening with us. And Mark, as usual, thanks for all you do. And I'm going to say good night, everybody.
And I'll say Happy Easter. I want an Easter egg.
Wonderful, wonderful. Happy Easter next Sunday, right?
All right. See everybody on the 30th.
Good night, everybody.
Good hunting.
One second.